Hey, you guys, we're going to talk about inventory and a new expense account called cost of goods sold. So far, we've really talked about service companies, companies that just provided a service like mowing someone's lawn, designing a website, doing a tax return, consulting. But chapter 6 introduces companies that sell stuff or inventory. So there's two kinds of companies that sell stuff: manufacturing companies and merchandising companies. A manufacturing company manufactures what they sell. So think of a furniture company that actually builds the furniture. And typically, not always, but typically they're wholesalers. They're selling to other companies that then just buy that table that they built, mark up the price, and resell it to the end user, the customer. And so that would be considered a merchandising company. Sometimes a company can be a manufacturer and a merchandiser, right? Depending on who they sell to. So when you're a merchandiser, think of most of the stores you shop in the malls. I'll use Dillard's as an example. When you're a merchandiser, you're not making the stuff you're selling. You're buying it from someone else. So when Dillard's, say they buy some Ralph Lauren shirts from the company Ralph Lauren, when Dillard's buys that stuff, that's called inventory to Dillard's. And stop and see if you can think, like looking at our balance sheet equation in the income statement, which category, which account inventory would be. So when Dillard's first buys the Ralph Lauren shirts, they still have them, right? They're hanging on the racks or back in their inventory room or whatever. So stuff a company has or resources a company has is called what? That's an asset. So inventory gets reported on a company's balance sheet under the asset category at whatever cost that inventory is. So for Dillard's, say they bought one Ralph Lauren shirt from Ralph Lauren for $50, it would get reported at $50 on their balance sheet. But Dillard's doesn't want to keep it. They want to sell that shirt. So when they sell that shirt to a customer, say they sell the shirt for $100, what happens then? Well, Dillard's has to remove it from their assets because they no longer have the shirt, right? And then what? Well, then that cost of that shirt becomes an expense on their income statement. So $50 is the expense. The revenue is the $100 that they charged the customer for the shirt. So from that one shirt, Dillard's would have a profit of $50. So as you're studying this chapter, don't get confused with cost and what they end up selling it for. A company hopefully isn't going to sell it for what they paid for it, because then they wouldn't make any money. How would they pay their rent, their bills, and hopefully have a little bit of profit left over, right? Okay. With that in mind, this chapter also goes over an expanded income statement called a multi-step income statement. And this is what we'll continue to use. Even in small businesses, this is what you guys would be used to seeing. If you're running your own business or you're a manager for a business, it's very rarely as basic as just revenues minus expenses. Although those are our two types of accounts still. We just add some detail to it. So I'm just going to show you an example of an income statement in this multi-step format using what you've already learned from prior chapters. So I'm going to start out, and I'm just going to be making up numbers, but I'm going to start out with gross revenues. Say this company had $103,000 worth of gross revenues. Well, remember in chapter 5, you learned that sometimes companies take returns. Have you ever returned something you bought at Target or Walmart or Dillard's? Yeah, probably. So sometimes companies take returns or offer discounts. And if they do, that reduces their revenues, remember? And so we have an account called sales, returns, and allowances in chapter 5. So say this company had returns or allowances of $3,000. That reduces their revenues. And now they have revenues of only $100,000. What do we call those? We call those net revenues. Remember those business terms, gross and net? Gross is the bigger number. Net means it's been reduced by something. Think of your own paycheck. You might make $20 an hour, but at the end of the day, when you get that paycheck, your net amount's not $20 an hour usually, because it's been reduced by taxes and insurance and whatever else. So, okay, hopefully you remember this part. You'll continue to have that on your second exam, your third exam, and even your final exam will have a big, long multi-step income statement like this. Now from here, we move on to expenses. Remember, an income statement says, how much did we earn in revenue minus what did we spend to earn that revenue? Well, when you have a manufacturing or a merchandising company, the first expense that's always listed on the income statement is a cost of goods sold expense. So I'm going to abbreviate this COGS, and you'll see that pretty frequently. Think in your head about that $50 shirt that Dillard's sold. Dillard's paid $50 for it, but they sold it for $100. Cost of goods sold is an expense account. A lot of students tend to forget that because it doesn't end in the word expense, but it's still an expense account, and it's the cost of the stuff you sold. So for Dillard's, yeah, they've got tons of expenses. They got to pay rent at the mall. They've got to pay all their employees. They have to pay utilities, but probably their largest expense is called cost of goods sold. The cost of all of those perfumes, shirts, shoes, all of that stuff they sold, right? Break it down really simple. And have you ever run a lemonade stand? You sat on the side of the road selling cups of lemonade for $1. What is your cost of goods sold? Well, that's how much ever you spent on lemons, on the sugar for it, the cost of the lemonade. You might have other expenses like marketing expenses. You bought some poster board, held up some signs, took out an ad in the paper, whatever. But the cost of the lemonade itself is an expense called cost of goods sold. Okay, so again, I'm just making up a random company here to show you these numbers and then show you how we develop some percentages after this. So I'm going to say, suppose the cost of all this stuff that they sold was $40,000. Now the company has $60,000 left over. If they earned $100,000, they spent $40,000 on the stuff that they sold. They've got $60,000 left over in their pocket. What do we label this? This is a really, really, really important term. You're going to have it on every exam. You're going to see it in real life a lot. It's called gross profit. Got that word profit in there. It's not the same as net profit or net income, though. Why not? Because we haven't taken out the other expenses yet, called operating expenses, things that we have to do to operate our business, like we've already mentioned, like paying our rent, paying salaries, paying advertising, whatever. So why stop and do a gross profit? These are called levels of profitability so that a company can examine how well they're doing. This is really important, and then you're going to have to learn a percentage related to this as well. This is really important because you can examine this percentage, and in fact, this is really easy to look and go, well, our gross profit is 60% of our net revenues. 60,000 divided by 100,000 is 60%. That 60% is important because what if next year, all of a sudden your gross profit is only 40%? Yikes, what happened? We're either paying too much for our stuff, our cost of goods sold has drastically risen, and maybe we need to find a new vendor that's not charging us as much for the shirts that we're selling. Or maybe the pandemic hit, inflation rose, and we just got to raise our prices because we're having to pay more for our costs. We're seeing that right now with restaurants and things like that. So gross profit is a really important number. But again, we still have other expenses. I'm just going to lump them all together and call them operating expenses. And again, I'll make up another number. I'll say those were $20,000. And now we get down to another level of profitability called operating income. So $40,000 of operating income. I'm going to put a check mark by our levels of profitability. Are we done? Is operating income our bottom line number? No. So a lot of times companies have what we call other income or expenses. What does that mean? I call it other stuff. Let's use that Dillard's example again. What's Dillard's in business to do? They're in business to sell shirts, perfume, shoes. But what if Dillard's wanted a makeover? They want to remodel and they want to get all new fixtures and shelves and things like that. So they decide to sell their other fixtures and shelves. And they sell them for a gain, for more than they paid for them. That's income or revenue to Dillard's, but it's typically not included up here with their regular revenue. Why? Well, because if you're my manager at Dillard's, or I'm looking at investing in Dillard's or a company like Dillard's, that's not a normal thing. Dillard's is not in the business of selling shelves and fixtures. So I don't want to judge them on that. It's probably not going to happen again next year. Maybe you took a big loss on it. I don't want you as a manager to get dinged for that, because it's not your job to sell shelves and fixtures at a profit, right? It's this once in a lifetime kind of thing that Dillard's did. So that's called other stuff. So below your operating income, you might have things called other gains and losses. So I'll just say this particular company had an other gain of $5,000. And now, are we finally at our net income of $45,000? Not yet. So I'm going to call this yet another level of profitability. I'm going to call this net income, I'll abbreviate NI, before income taxes. Stop and ask yourself what kind of account you think income taxes would be. It's an expense, just like all the other expenses. So again, doesn't end in the word expense, but it's an expense. Personally, we have to pay income taxes on income we earn. Corporations also have to pay taxes on income the corporation earns. So income tax is an expense. It's not typically included with these operating expenses though. One more time, why not? Well, because we like to separate it out from looking at the operations. We're trying to isolate the operations of this company so that I can judge how well the company was run. If you're my manager, managers are often bonused off of how well they run a company. So I'm more likely to look at the operating income to bonus you off of, because you can't control this other stuff if you decide to remodel. You can't control taxes. So I want to isolate it to how well are you operating the company. So taxes are typically the very last expense included on an income statement. So I'll put tax expense, and I'm just going to make up a number here. I'm going to say their taxes were $9,000. Of course, that would reduce what they have. And finally, we get to net income. At the very end of the day, $36,000 in net income. Now let's talk about percentages and what I was talking about earlier, what we want to convert this to. There's my level. So I've got 4 levels of profitability. Make sure you know those. Make sure you know how to spread this income statement out. Look, y'all, it's still just revenues minus expenses, right? Notice that every one of these expenses decrease the amount we get to keep in our pocket. We started out, customers gave us $103,000, but then we had to give $3,000 back to customers. We had to give $40,000 of it just to buy the stuff we sold. We had to give $20,000 of it to rent and employees and whatever. And at the end of the day, we're left with only $36,000 in our pocket. So there's something called vertical analysis that you'll need to do in this chapter, and you'll also have it on your final exam. Chapter 12 is full of vertical analysis. Super relevant real life. Even if you own a small company, this is really relevant and important. So I want you to know this really well. I've already talked to you about how I looked at the gross profit percentage. Vertical analysis takes every single item on a financial statement and expresses it as a percentage of the same base amount. What is the base amount? Net sales or net revenue. Notice that means the same thing. I can call this net sales, means the same thing as net revenues. So what percentage is gross profit of net revenues? You just say 60,000 divided by 100,000, and it's 60%. What does that mean? It means out of every dollar I got from my customers, I got to keep 60 cents of that dollar after paying for the thing that I sold. You know, say I run a little t-shirt shop. I'm buying my t-shirts from Hanes and then I'm screen printing them. Well, I've got to pay Hanes for the t-shirts. So I kept 60 cents there. What is my cost of goods sold? It's 40%. And this is the number I was telling you, it's really important. What if next year my cost of goods sold goes up to like 50%? Yikes, my vendors are charging me more, right? Can I find a vendor that's not charging me as much? Or if everybody's gone up on their prices, I need to go up on my prices too. really important to analyze these numbers. We get down to operating income. 40,000 is what percentage, again, of that same base amount, net revenues. So 40,000 is 40% of 100,000. This is more likely what I would be looking at if you were my manager and I was bonusing you on how well you were running that restaurant that I owned or that t-shirt shop that I owned, because this tells me how well you ran the operations, controlled your operating expenses, controlled your cost of goods sold, how well you generated revenues, sales, things like that. And then, you can do this for every number on here. I'll go ahead and skip all the way down to net income. At the end of the day, this is what I'm super duper concerned with. How much did I get to keep in my pocket after all of these sales? Well, if my net income is 36,000, 36,000 is what percent of net revenues? 36,000 divided by 100,000 is 36%, right? So that's my bottom line net profit. So I can compare that to myself year after year after year if I'm a company. Say you're my manager for 5 years. Hopefully I want to see that growing every year, right? Not only do my sales need to grow, but what I get to keep at the end of the day needs to grow too. It's not going to do me any good for my sales to grow exponentially if my expenses are growing even more. This is also for and things like that. Look at the Collins Street Bakery case that I put in chapter 4. Local bakery here where their controller, their CPA that worked for them, they're just little mom and pop shop accountant, stole like $13 million, something crazy like that. He was spending all the company's money on himself, gobs of Rolexes, private jets and trips and minks and cars. And he was recording it in the company's books. He was recording it as cost of goods sold. So that company, if they had known this one little ratio or percentage to look at, would have realized, holy smokes, our cost of goods sold percentage is through the freaking roof. And is flour really rising by that much in cost? Are pecans really going up that much? Is butter price going up that much? No. Well, then let's look into that. What's happening? Because all of our profits are just gone. Well, all the profits were going into this dude's pocket, buying his Rolexes and cars and stuff. And they just didn't look at it because they weren't accountants. They had hired him to be the accountant. So when it's your company and your money, you need to look at the numbers every now and then, right? You want to know, you want to make sure you're getting to keep as much of your money as possible. So that's a multi-step income statement. Hope that helps.